Hey guys, what's up? Welcome back to another video. In this video, I'm going to be talking about 7 stocks in the stock market right now that have fallen pretty low from their all-time highs, and they also have extremely strong fundamentals. And so I'm going to look at them from an analytical value investing perspective to try to figure out their intrinsic value per share by using a discounted cash flow model. And typically in videos like this, I usually talk a little bit about the background of the business and how they actually make money. But since I'm going to be looking at a couple of different companies in this one video, just to save time, I'm only going to focus on the financial metrics for the actual companies as opposed to how they produce revenues and their competitors and things like that. So thanks in advance for leaving a like, and let's get right into it. And then also I should mention that of the 7 stocks I'm going to be talking about in this video, I'm actually holding on to 3 of them. And in the end of the video, I'm going to discuss why I chose those 3 out of the 7. So as we can see right here, the first one is Zoom. And from their all-time highs, even over the last year, Zoom has fallen by 70%. And from their all-time highs of nearly about $559 per share, they've fallen even more than that. So we can see that based on this, they could present a good buying opportunity. Currently trading at a PE ratio of about 25, 26, around there. And if we were to look at their financial statements, we can see from their balance sheet that their business is expanding. Their total assets grew year over year from the year ending January 31st, 2021 to 2022 from about 5.2 billion to 7.5 billion. So that's good. They're definitely able to use their assets to produce more revenues and profits in the future. And then on top of that, we can see that from their total equity, that their total stockholders' equity has grown a lot as well, from 3.8 billion to 5.7 billion. And we can see that the majority of that growth came from an increase in retained earnings from about 670 million to $2 billion of retained earnings, which is really good because obviously if we're looking at a company and their stockholders' equity is growing, it could be a good thing or a bad thing depending on how it's growing. If it's growing through an increase in additional paid-in capital, then that could be bad because that could mean that the previous shareholders are getting diluted. But if it's growing as a result of an increase in retained earnings, then that could be good because it means that the business is expanding and they're increasing their revenues. And then also, what's even more impressive is their income statement. As we can see right here, year over year and from 2 years ago, we can see their revenues have pretty much exploded almost 10x from 600 million to $4 billion of revenue, and their net income has increased from only 25 million to $1.3 billion of net income. So Zoom has been on an absolute tear over the last few years. And if I were to look at their intrinsic value per share here using this discounted cash flow model, these are some estimates that I got from Yahoo Finance. That's how I'm going to be doing the discounted cash flow analysis for all of the stocks in this video. We can see that their intrinsic value per share is estimated to be about $130 per share. And so compared to their current share price, that would mean that Zoom is currently priced below their intrinsic value per share, but they have not quite hit the 30% margin of safety of $90 or the 50% margin of safety of $64 per share. So, depending on what price someone wants to buy into Zoom at or what kind of return they're looking to get, at the current price, it would seem that based on Yahoo Finance estimates that Zoom is trading below intrinsic value per share. And they also have extremely strong fundamentals to boot. So the second stock that I want to look at is Google, or their parent company, Alphabet. And we can see that Alphabet has not tumbled nearly as much as Zoom has over the last year. Zoom fell by about 70%. Alphabet is only down about 14%. But that's still a pretty good amount from their all-time highs of almost $3,000 per share. Currently trading at a P ratio of about 19 times earnings, which is actually lower than Zoom's, which was trading at about 26 times earnings. And if I were to look into their financial statements here, we can see that Alphabet, their financial statements are backwards. 2021 is over here, 2020 is over here. But we can see that the total assets have also increased from 319 billion to 319 billion to $359 billion of total assets. So obviously absolutely huge. Alphabet is like one of the biggest companies in the world. And then we can see right here from their stockholders' equity, their stockholders' equity also increased mainly as a result of an increase in retained earnings. So that's also all very good. And then from their income statement, we can see that although Alphabet is one of the biggest companies in the world, they are definitely not having trouble increasing their revenues and their profits over time. We can see that just over the last 3 years, their net income has increased from about $34 billion to what is now $76 billion for the year ending in 2021. So that is extremely impressive for Alphabet. And if I were to look at their intrinsic value per share here, we can see that they're estimated to grow compounded annually over the next 5 years by about 17% per year. And if I look at their intrinsic value per share, check this out, we can actually see that according to Yahoo Finance estimates, as well as taking the cash flows from their current business in 2021, it's estimated that their intrinsic value per share is about $4,800 per share, with a 30% margin of safety of $3,400 and a 50% margin of safety of $2,400, which compared to their current share price means that Alphabet is currently trading at below a 50% margin of safety compared to their intrinsic value per share of about $4,800 per share based on the current cash flows that are being produced by the business. So although Alphabet has not fallen nearly as much as Zoom has over the last year, they are trading at a far lower price to earnings ratio, and according to Yahoo Finance estimates, they're currently trading at a below a 50% margin of safety relative to their intrinsic value per share. So that could mean that Alphabet presents a good buying opportunity. And on top of that, just like all the other companies on this list, they have great underlying financial health. So the next stock that I'm looking at is Meta Platforms, previously known as Facebook. And we can see that they've absolutely gotten destroyed over the last year. We can see they're down about 51%. They were up to about $400 per share at one point. And we can see that they're trading near their lows around the start of the global lockdowns in March of 2020 of about $150 per share. Currently trading at a P/E ratio of just 12, which is absolutely insane considering that Meta is one of the biggest companies in the world, and it's a tech company on top of that. And if we look at their financial statements, we can see from their balance sheet that their total assets have increased year over year from 159 billion to 165 billion. It's pretty crazy to think that their total assets are $165 billion, and then their market capitalization is 443 billion. So it's pretty close to their book value, I would say. And then also we can see from their stockholders' equity, this is actually kind of alarming. We can see that their stockholders' equity has decreased, even though their additional paid-in capital has increased. So that could suggest that their previous shareholders are being diluted because Meta is raising more money to fund their business operations from outside capital. But that being said, their stockholders' equity is still decreasing because their retained earnings is decreasing as well as other factors too. And if we look at their income statement, we can see that their business is growing fast, even though it's one of the biggest businesses in the world. Obviously, the bigger a business gets, the harder it gets to keep these very fast growth rates, but Meta doesn't seem to be struggling with that as much. We can see that in 2019, their net income was $18 billion, and then in 2021, it was $39 billion. So they pretty much doubled their net income over a 3-year period. And if we look at their intrinsic value per share here, based on Yahoo Finance estimates, we can see it's estimated to be about $247 per share, with a 30% margin of safety of 173 and a 50% margin of safety of 123, which compared to their current share price means that they're currently trading at a little bit less than a 30% margin of safety, but not quite at the 50% margin of safety level. And so the next stock I want to look at is Nvidia. And Nvidia over the last year is down about 15% from what it looks like, but from their highs in November of 2021, definitely, or were those even their highs? Yeah, it was around their high point right there in November of 2021. They're down even more than that, almost by about 50% from 329 down to 158, 160 around there. P/E ratio of about 42 times earnings. And if we look at their financial statements, we can see that their net income has increased by an absolutely insane amount from about $2.7 billion to what is now $9.7 billion just 3 years later. So that's pretty crazy growth right there. And if I scroll down here and look at their balance sheet, we can see that their business has been expanding pretty rapidly. Over the last year, it expanded from $28 billion of total assets to $44 billion of total assets. So pretty insane growth right there. And we can also see that their total shareholders' equity has increased from 16 to 26 billion, even though their retained earnings have unfortunately decreased. So sort of in the same boat as Meta platforms in that regard. Then also, if I look at the discounted cash flow model, we can see the intrinsic value per share estimated to be about $91 per share. So compared to their current share price, even though they've tumbled quite a bit from their all-time highs of about $330 per share, according to Yahoo Finance estimates, they still are not hitting their intrinsic value per share. They're still priced a little bit too expensive relative to their intrinsic value per share, according to Yahoo Finance. So the next stock I'm looking at is AMD, which is one of Nvidia's competitors. And we can see that over the last year, they're down only 3%, which, I mean, it's really not that much at all compared to Zoom, which is down like 70%. At their all-time highs, they were trading about $161 per share. Now they're trading at about 81, so they're down about 50% from their all-time highs here. We can see PE ratio of about 30 times earnings. And if I look at their financial statements, probably one of the most impressive income or revenue growth that we'll see across any of the stocks on this list. We can see that their net income has pretty much 10x'd over the last 3 years, from about 340 million to 3 billion, or 3 billion. So that's pretty crazy growth right there. Over the last 3 years, they pretty much 10x'd their net income, and their revenues have grown from about 6.7 billion to 16 billion. So that's pretty crazy growth right there for AMD. And if I scroll down here and look at their balance sheet, we can see that total assets have increased from 8.9 billion to 12.4 billion dollars, and then their total stockholders' equity has also increased from 5.8 billion to 7.4 billion. And interestingly enough, we can see they don't actually have retained earnings on their balance sheet. They have an accumulated deficit, which means that they've mostly been operating at a loss for the majority of their historical business operations. But as we can see right here, I mean, it decreased pretty substantially year over year from 4.6 billion in the negative to only 1.4 billion in the negative. So, I mean, judging by this pattern, by the time they release their 2022 annual report, they might actually report positive retained earnings, which would probably be a pretty big catalyst of growth for AMD, especially considering the fact that their revenue has been growing so much already, and they're up about 600% over the last 5 years. That's pretty impressive. If we look at AMD's intrinsic value per share here, we can see that they're trading at about $88 per share of intrinsic value per share, estimated to grow at about 32% over the next 5 years, which compared to their current share price means they're currently trading at about intrinsic value per share, not quite hitting the 30% margin of safety or the 50% margin of safety range, but they are trading at about intrinsic value per share despite the fact that they're trading at about 30 times earnings. So the next company I'm going to look at is Etsy, and Etsy is down about 57% over the last year, so not quite at Zoom 70%, but definitely one of the stocks that's been hit the hardest on this list. And that's not even from their all-time highs. Their all-time highs were around $296 per share, so they're down even more than 57% from their all-time highs. But despite the fact that they're down that much over the last 5 years, they're still up 400%. At their all-time highs, they were up about 2,000%, so that's pretty impressive. Currently trading at a PE ratio of about 20 or 30 times earnings, around there, in between there. This is their balance sheet, and we can see that their business has expanded over the last year from $2.4 billion to $3.8 billion of total assets. Total stockholders' equity has decreased from 700 million to 600 million, and that looks like that mostly came as a result of a decrease in additional paid-in capital. But we can see that their retained earnings have absolutely exploded. They had a negative accumulated deficit in the year ending 2020 of about $146 million, or is that million or billion? I believe, it's million. So $146 million in the negative, and now they have a $71 million positive of retained earnings. So that's pretty impressive for Etsy. And also from their income statement, we can see that their net income has almost, I mean, it's pretty impressive. It's grown almost as much as AMD's, from about $95 million to what is now almost $500 million just 3 years later. So that is pretty impressive growth for Etsy. And we can see from their discounted cash flow analysis here, according to Yahoo Finance, they're estimated to grow at about 41% compounded annually over the next 5 years. And their intrinsic value per share is estimated to be about $300 per share, with a 30% margin of safety of 210 and a 50% margin of safety of 150, which means that at the current share price, they are completely trading at a discount, like way below their intrinsic value per share and way below a 50% margin of safety of $150 per share. I mean, they're trading at $70 per share. I think this week they literally they hit like 60 something dollars per share. So I mean, according to that, that would mean that Etsy is trading at a massive discount right now. So it could potentially present a good buying opportunity. They have strong financials, so I'll be interested to see where Etsy goes from here. And then the last stock on this list is probably one of the most popular stocks on my channel. I think I made a video about this and it got like almost 3,000 views. I have no idea why. But Epam systems, we can see over the last year, down about 40 to 50%, around 42%. At one point, they were down even lower to $186 per share. And over the last 3 months, well, I guess it doesn't really show the growth anymore because it's been a while. But I know at one point, I mean, they were trading at $186 per share. This was around when I made the video about it. And since then, they've absolutely exploded. I mean, they've gone up like almost 100% since then, so that's pretty cool. Congrats to anybody who like bought into the stock when I made a video about it, but I didn't, so I took that L. Anyway, price to earnings ratio of about 37 times earnings. And if we look at their financial statement, their balance sheet here, we can see that their business has expanded from about $2.7 billion of total assets to $3.5 billion. And also their total equity has grown from about $1.9 billion to $2.4 billion of total stockholder, or not total equity. I meant to look at total stockholders' equity. It's also increased from about $1.9 billion to $2.4 billion. Retained earnings has increased from $1.3 billion to $1.8 billion. And their income statement, as we can see, they've had pretty good growth over the last 3 years. Probably not as impressive as some of the other stocks on this list, but they have grown from about 260 million to 480 million. So they've almost doubled their net income over the last 3 years, which is pretty impressive. And if we look at their intrinsic value per share here, we can see that they're estimated to have an intrinsic value per share of about $230 per share, with a 30% margin of safety of 161, 50% margin of safety of 115, which means that they're currently trading at a little bit higher than their intrinsic value per share, actually. So according to Yahoo Finance estimates, they're basically saying that at the current share price, EPAM Systems is overvalued. Not sure if that's an accurate representation of EPAM Systems, but it is the one that I got from Yahoo Finance. And we can see that they're trading almost near their lows of around 175 in 2020, or actually they're not anymore, but they were at one point. And they are still down quite a bit from their all-time highs of around $705 per share. At that point, they were up about 700% over the last 5 years, but now they're only up about 255%. So that basically covers all of the stocks that have fallen quite a bit, that have strong financials. And so now I'm going to reveal the 3 that I'm holding on to. And those 3 stocks are Google, Meta, and Etsy. And I'm going to get into the reasons why I'm holding on to these, and I actually did a competitor analysis for these, as we can see right here on the right. If we look at Google's ratios right here, their gross profit margin is pretty competitive relative to the other tech stocks in their industry. You see they're higher than Apple, they're higher than Amazon, but they're not quite beating out Meta and Microsoft. Then we look at their net profit margin. Net profit margin is higher than Amazon's and Apple's, not quite beating out Microsoft or Meta though. And then their return on assets is higher than Microsoft's and Amazon's, but not quite beating out Apple's or Meta's. So Google is sort of near the middle of the pack in terms of ratios. But as we saw earlier from their intrinsic value per share, they're trading at below a 50% margin of safety according to some of the estimates from Yahoo Finance. So that could mean that they're a good buying opportunity, and they're only trading at about 19 times earnings. And also it's Alphabet. I mean, it's one of the most valuable companies in the world. They own pretty much almost like all of the search engine market, and they own YouTube. So seemed like something that I might want to hold on to for a decent period of time. So that was the reason why I decided to invest in Google. And the next one I decided to invest in was Meta. And I wasn't really sure if I was going to buy into Meta, mainly because, I mean, I don't know. Like, there are just a lot of different stocks in the stock market, and I wasn't sure if I want to invest in Meta for the long term. But they did tumble quite a bit from their all-time highs here. And on top of that, they're currently trading at an extremely low PE ratio of only about 12. And they're trading at below a 30% margin of safety. And also, as we saw from the competitor analysis earlier, they have pretty good ratios relative to the rest of the industry. They have the highest gross profit margin across all of the tech stocks. They have the second highest net profit margin behind Microsoft. And they have the second highest return on assets after Apple. So although their stock price has tumbled quite a bit, and although we saw some like questionable things from their stockholders' equity in their financial statements earlier on, their income statement was pretty impressive earlier. As we can see right here, they were increasing their net profits and their revenues quite a bit. And on top of that, they're trading at a little bit of a discount right here. So that was one of the reasons why I decided to maybe take a little bit of a gamble and put a little bit of money into Meta platforms. And then lastly, my reasoning for buying Etsy. I mean, we saw that Etsy was probably trading at one of the cheapest prices relative to their intrinsic value per share of all the stocks on this list, at about a 50% margin of safety of 150, and they're currently trading at $72 per share. That seemed like a no-brainer to me. I felt like I could put a little bit of money into Etsy just to see where it goes in the future. On top of that, despite the fact that they're down this much over like the last year, about 57%, they're still up about 400% over the last 5 years. And at their all-time highs, they were up about 2,000% over the last 5 years. So, and then on top of that, obviously, when we looked at their financial statements, they've had some pretty impressive net income growth from about $95 million to about $493 million. So I thought I might put a little bit of money into Etsy just to see where it goes. And that pretty much covers those 3 stocks that I chose. Not sure how long I'm going to hold on to them. I might change my mind literally right after I upload this video. I have no idea. But that basically sums up my reasoning and also sums up the 7 stocks in the market that have tumbled quite a bit that I've been looking at that also have really strong underlying financial health. So hopefully this video provided some value to everyone who's watching it. If it did, be sure to leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.